Hey, and welcome to week one of the second season of Math.Logic.Wealth. Week one of 50 weeks. So 50 weeks is a long time. Feel free to hit exit button now if that's a little much and you didn't expect such a thing. So there are these two economists who are sitting in a bar. And the first one asks the second, "How's your wife?" And the second replies, "Compared to what?" Now, the joke may not all be that funny, but it conveys a deeper truth that we often make judgments by comparing. And it was funny because yesterday, Seth Godin, who I read every day, wrote in his daily blog that compared to what is one of the most powerful questions we can ask about any financial decision. And that's exactly where we begin our examination of the life insurance product. Compared to what? Now, everyone thinks they know what life insurance is, but before allocating any money to life insurance, we need to answer two fundamental questions. Does it work? And this is where we start today, 15 minutes. Here's my top five about whether it works or not. And the next question really is, how can we make it work better? And this is where we're going for the rest of the year. So what makes our approach different is that we use math to optimize any allocation to life insurance. So whether you're a consumer wondering how much to allocate, or a professional advising clients, or anyone seeking to understand life insurance as part of a financial portfolio, our commitment is about getting the highest probability of return on your investment through evidence-based analysis. We're not here as tax accountants or estate planners. We're here as product experts focused on one thing, using math and logic to share whatever information we have so everyone can make the most informed decision possible about life insurance product they're considering. So let's begin. We start first with the problem. And the problem is death. I mean, it creates real problems. And not so much for the person who dies, but for those left behind. So while we can't predict or solve all these problems, we can address the financial impact by ensuring some cash is available when death occurs. It's that simple. Death will happen. We just don't know when. And that uncertainty is precisely why having financial resources available at the exact time of death can be critical for some situations and helpful in others. As Glenn Reed from Estatecraft said in September of 2007, he framed the broader context, I thought, perfectly about what the problem is. The client should be asking themselves, how do I achieve financial confidence and financial dignity in a prudent and predictable way, such that the risks of life don't thwart any important life goals? And life insurance addresses one specific piece of this question by providing a guarantee of cash at death. Nothing more, nothing less. And that's the problem we're solving. Everything else is just details. So when we look at the products, we break them down into categories. I say every product is a B plus. I couldn't find any evidence that one product will perform better than any other without making unsubstantiated assumptions. I'm not an actuary. I focus on what we can verify, not what we hope to sell. So this chart organizes all life insurance products into three simple categories, right? The first one, convertible term, is a cash-like component. Our industry's biggest misconception is that term insurance is wasted money. The evidence doesn't support this claim. The key advantage, flexibility to convert to permanent insurance when it makes sense for the client. And the next one is non-par products. They're bond-like. They're not par. They're like bonds. These offer guaranteed costs, clear contractual terms, different variations let us match specific client needs, and the policy owner can choose how to manage the variables and the investments. And the last one is par. It's an equity type product. Costs more initially, but offers potential for higher long-term value. Requires trust in non-guaranteed projections. And they have new Office of Superintendent of Financial Institutions, and the CIA guidance provides better oversight on non-guaranteed elements these days. So when building a portfolio of life insurance products, we select the best option from each category based on the client's specific needs and circumstances. Remember Einstein's principle, make things as simple as possible, but not simpler? We should stick to what we know and can prove with evidence rather than making claims we can't substantiate. The guarantees. What does the policy contract say? You know, the rating of the products is B plus doesn't mean they all offer the same level of guarantees. What matters here is what's in the actual policy contract wording, what specific options are contractually guaranteed, how do the financial on-ramps work in ways to get money into the policy efficiently over time, and how do the financial off-ramps work, ways to access money when needed through loans and withdrawals and surrenders, how these options can be used over the next few decades to optimize returns. Let me show you something about assumptions versus reality. And look at this. According to these financial planning guidelines, you should put 100% into emerging market equities for that guaranteed 8.3% return. Nothing else even comes close. You know, this is exactly how life insurance is often sold, comparing projections instead of reading the contract. For a policy that needs to perform over decades, what matters is understanding the guaranteed options in the contract that let you optimize your returns, how to time your premium payments, when you can access cash value, what flexibility you have with loans, how to manage your tax advance, what surrender options. Because in 30 years, no one remembers the projection. They remember what options the contract actually gave them to optimize their investment along the way. We have something called Sweeteners. It's a mathematical reality. And I want to start with something William Strain observed that he presented at the Canadian Tax Foundation in 1993. He called the article Life Insurance, an Innovative Financial Instrument. His detailed technical analysis ended with, and I quote, life insurance is increasingly being recognized. This is 1993. Increasingly being recognized as an extremely versatile tool to be used in the business and personal financial and tax planning process. However, the results derived from particular applications will reflect not so much the quality of the tool as the skill of the artisan. Now, I don't disagree with many things that Bill Strain said, but I don't believe he gave sufficient credit to the product design process. To get the best results, the life insurance artisan needs the tools. And without a diversified portfolio of life insurance products to work with, the return potential is extremely limited. We need more. The foundation that we're offering is a mathematical reality. Let's begin with an undeniable truth. Life insurance returns can be measured through straightforward math. It's at its core. We're looking at a simple equation. Money paid in minus money paid out equals the rate of return. This transparency is our starting point for all client discussions, or at least it should be. The fascinating aspect of life insurance returns is their dynamic nature. Early death creates extraordinarily high returns, which then decreases as time passes. And instead of leaving this as an abstract concept, we anchor our analysis around normal life expectancy. This gives us concrete numbers to work with. Typically a guarantee of about 2 to 5% internal rate of return at life expectancy. But what makes this measurement interesting is where the money gets allocated into what we could view as an investment wrapped inside a life insurance policy contract. This isn't marketing speak. It's a structural advantage that changes the entire investment proposition. When money enters this wrapper, it gains special properties that affect both accumulation and distribution. This wrapper, a detailed policy contract, changes everything. It's not just another financial product. It's a government-sanctioned chassis with layers of protection that should give every advisor confidence in recommending appropriate allocations. Think about it. Federal and provincial regulations, actuaries keeping watch, mandatory capital reserves, an industry-funded protection system through Assurus, seg fund accounts that keeps insurance money separate from company operations, and annual oversight by OSFI. When clients ask about the security of their money allocated to life insurance, this robust framework of protection sets it apart from most other financial instruments. Here's where it's getting interesting. That base return of 2 to 5% IRR is just our foundation. Through careful application of tax advantages and strategic policy design choices, we can significantly enhance those returns. We're not talking about hypotheticals. These are measurable improvements that come from understanding and leveraging policy features. We could take the easy route, jump straight to emotional appeals or complex features. But our approach is different. By starting with these guaranteed returns and methodically exploring enhancement opportunities, we build a strong foundation for client trust. This allows us to have transparent discussions about additional sweeteners that match each client's specific situation. I believe we should always start with the mathematical foundation. Frame the insurance wrapper as a structural advantage, not a marketing feature. Use life expectancy as an anchor point for measuring return. Present enhancements as systematic improvements, not magical additions. Build from guaranteed returns to potential optimizations. Now, throughout this year, we're going to explore every aspect of the life insurance product. And as you can see from this slide, weeks 31 through 38 are dedicated to what I call sweeteners, specific elements that can transform a policy performance from basic guaranteed returns of 2 to 5% IRR to something far more powerful. As licensed insurance professionals, we have a responsibility that goes beyond just selling policies. Our job is to understand how to optimize these financial instruments for every client who trusts us with their allocation. Each sweetener we will study represents an opportunity to enhance returns while maintaining that exceptional level of security the insurance wrapper provides. When properly understood and applied, these sweeteners can help turn modest guaranteed returns into significantly enhanced results. It's about knowing not just which sweeteners exist, but when and how to apply them for each client's unique situation. This is the optimization process. And let me start where we always start. Does it work? And how can we make it better? That was our focus today. Does it work? And this is our final key point for today. Now, I'll show you our conclusion from last year, the 5 steps that will provide your customers with our best advice as to how to optimize the financial return from this somewhat mathematically complex financial instrument and make it simpler. And what sets our approach apart is pretty straightforward. We use math to optimize any allocation to life insurance, period. Whether you're a consumer trying to figure out how much to put in, a professional helping clients make these decisions, or just somebody who wants to understand how life insurance fits into a financial portfolio, our commitment should be to be product experts who study, shop, and address product nuances for the benefit of the consumers we serve. We focus on getting you the highest probability of return on your investment through evidence-based analysis. That's what this optimization process is all about. Now, let me show you how it all comes together. Before I walk you through these 5 components, let me share a story about Albert Einstein. One day, while handing out the final exams for the second term of his physics course, a student raised his hand and said, "Professor Einstein, you've given us the wrong exam. These are the questions from the first term." Einstein smiled and replied, "Yes, those are the same questions. But this term, the answers are different." I'm sharing the same slide from our final class last year for a similar reason. While these 5 components, the allocation method, the product rankings, diversified portfolio, bank financing, and the holding statement, remain our foundation, how we understand and apply and tell stories about them continues to evolve through our collective experience and insights. Each of these components represents a systematic approach to making life insurance work better for our clients. But what makes our community special is that we're not just implementing these methods, we're continuously learning, questioning, and improving them together. What my late business partner, Don Morrison, taught me, and what I've come to deeply appreciate, is that there's room for both logic and emotion in our business. While we ground ourselves in mathematical analysis and systematic processes, we also recognize that each client interaction brings new perspectives and challenges that help us refine our approach. These 5 components aren't just a framework. They're the starting point for our ongoing dialogue about how to better serve our clients. And as we begin this new season together, I invite you to bring your experiences, your questions, your insights, because while the fundamental questions about optimizing life insurance remain the same, we're all part of discovering better answers. Let's explore how we can build upon these foundations to create even more value for the consumers we serve. And as I end each session, here's a summary, the 5 slides only. We talked about the problem, the products, the guarantees, the sweeteners, and the optimization process. So thanks for listening. I'm going to sign off now and hope to see you here next week.